The Rebel Capitalist Show.
You know, I just spoke with Chris Cole. I believe it was last weekend or the week prior. And part of our conversation revolved around the importance of portfolio construction. And I told Chris that so many people that comment on my videos or I talk to in the live streams, they get hyper focused on just what is the price going to do of XYZ asset. And they totally ignore portfolio construction. They ignore their time horizon. And I think it should be the opposite, that they should place even more emphasis on the portfolio and how the assets interact with one another, but also their time frame. It's so much, you could say that you're extremely bullish on commodities or oil, and you could be referring to the next 3 weeks. And then someone else like Jim Rogers might be referring to the next 10 years. And it's apples and oranges, and people conflate the two. So from a professional standpoint, why is that important? And to choose one and then to understand what it is and then stay in your lane.
Oh boy, great question, George. Staying in my lane has become my specialty because I learned that when I step out of it, I get burned. So staying in your commodity lane, but let me get right directly to your question about, time horizon. You brought up a good point about, whether somebody's trading short term or long term.
Right.
And the way I try to approach that is to have my long term view, constructed within the market. I want to have my portfolio for the long term match my fundamental view of the market, and then the timing of whether I'm bullish or bearish a commodity for a period of time is very much for a specific trade entry point where I say, okay, now I want to ride this trend that I believe I've got right fundamentally for a trade from point A to point B, right? And for me, it's when the risk reward lines up in price much more than the time, but that's when I'll start getting into a trade and start placing, when I start a trade, George, I put on a stop loss, say I'm buying something to get long, I put on a stop loss below the market, a target above the market. And I also have an egg timer on the position, right? Because time kills all trades. So if you tend to be in a trade over a long period of time that's not doing anything, not performing, that's when I kind of check myself and decide whether or not that trade should be exited in the interest of entering something else that I may have on that's performing better.
Right. There's an opportunity cost there.
Yeah, exactly. So kind of that's how I look at it. For me, time frame is kind of, I'm in a trade for as long as the market lets me be, to be quite honest with you. I try to maneuver into a trade with the opportunity to leave a trailing stop loss so that I let the market take me out. That's kind of the way that I've battled becoming better at exiting trades. That was a struggle for me for a long time. And then I finally developed a system where if I'm right, I just keep bumping my stop loss below, and sometimes, you don't, with that, in that scenario, you don't know whether you're going to be in a trade for 2 weeks or 2 months, right? Because sometimes the trend just keeps going and you keep rising your stop with the markets and you stay alive. So, that's kind of how I play the time factor of the commodity markets, if that's fair to say.
Yeah, for sure. So do you have a core long-term position that you don't touch and then you just trade around that? Or is it just trading back and forth with that long-term view, kind of that macro overlay?
So the way I work it in my newsletter, George, is that I run a view matrix, right? My view matrix will take positions that I start off with usually on the bottom of the view matrix, which is a radar screen. The radar screen will tell you, I've been watching these sectors. I've decided that these are the sectors I want to pile into because they're telling me that they're performing, right? I'm studying them on a daily, weekly, and monthly closing basis. And I'm generally shuffling the winners into my radar screen saying, okay, for example, metals and mining, energy, natural resources spaces started performing, at a certain point last year. Okay. And so those performances guided me into these sectors, right? So it's like I'll bring those sectors from the radar screen up into the view matrix when I say, okay, it's time to have this trade on, right? Like we were at an entry point, we're either at a breakout point or a value level technically where I could put on a trade, and then we'll go ahead and manage the risk reward from there. So it's pretty methodical about number one, a pretty methodical system about number one, following the market's performance so that I don't find myself imposing my view on my book so much. And I'm very much letting the market lead me into it. And then, like you said about the real timing for a trader like me is, I've been bullish oil for a year, but I've been in and out of long positions probably 6 or 8 times over the course of the year, where I'll say, okay, this is an opportunity where I can catch a $5 oil trade, and kind of that's generally how I'm managing my book.
My guess is 90% of the people that try that strategy, basically market timing with a long-term view, lose all their money. That's just my guess. So let me know if I'm wrong. But if I'm correct there, what mistakes do people make? That they just go in at the wrong time. They get emotional. They don't watch their stop losses. They turn it into kind of like, I've got a hunch. I'm using emotion instead of setting up a system. I always reference back to my days playing Blackjack, and I'm sure you've read the Market Wizards books. And that's one of the things that struck me first, reading that first Market Wizards books, is almost every single one of those guys started off in Blackjack. Yeah. And you kind of say, okay, well, why? Well, what they did is they just took the core principles of Blackjack and applied that to trading options or stocks or currencies, what have you. And so what I'm saying is it's rules based. And you have to have a rules-based system. And if you don't, from what I'm speculating, you're most likely not going to have an edge. Therefore, long-term, you're most likely to lose money. Is that safe to say, or am I wrong there?
No, George, I would say that developing a system of at least core risk management is absolutely necessary in terms of survival as a trader, right? And I talk about survival as a trader because, the whole, you learn at a very young age is that the idea is to stay alive, right? And when you sat down at Goldman Sachs and Jay Aaron, you knew that the guy that was sitting down there that's been trading oil for 40 years has managed to evolve with the markets and stay alive in the markets, right? And so that's the way you look at things, and you say, okay, no matter what, my goal number one is I don't blow myself up, right? And so you start with that. But I've developed a system, George, that I would say just piling into markets is a way to go broke. I've developed a system where I'm really very much developing patience, and once I decide that I want to get into something, I've done my homework. I decide that the oil market is constructive and I think it's got a long way to go. Then I'm really applying my technical analysis overlay and saying, okay, well, I've got to be patient until it gets to a level that I can buy it, because never am I going to, have completed my homework on a trade, decide I'm going into it, and also have the price sitting there at a place that I want to trade stock or trade a commodity. It's always a waiting game. And it's either, I'll force myself into a position either by forcing myself to wait for it to depreciate to a certain level or break out on the upside to a certain level, because I've had some success as a momentum trader and I figured out how to manage that type of risk. So, there's all different ways to skin the cat.
Yeah. How do you balance staying in the game and managing that risk, but then also having the balls, for lack of a better term, to take action? And what I'm referring to is, I remember a conversation I had with a guy that I met in St. Bart's through my good buddy Hugh Hendry. And this gentleman, I won't say his name because he likes to keep a low profile, but you'd recognize him from CNBC, hedge fund manager, managed billions of dollars. And we were having dinner one night, and he was telling me the story of how he became a hedge fund manager. And I believe he was working at a firm in Asia or something like that. And he was just, he was very young. And he just kind of forced his way into the conference room during these big meetings. And finally they said, okay, kid, here's whatever, $1 million, go see what you can do. And they gave him the $1 million. And then they also gave a lot of their top research analysts $1 million. And he said that the reason why he became successful and all those other people didn't, even though they were 10 times smarter than he was, is because those research analysts knew all the facts. They knew all the data, but they couldn't pull the trigger. So at the end of the 2 months, they still had the $1 million, but they didn't make a trade. Where he had the nuts, the huevos, to go in there and say, give me $1 million, give me 10 million, give me 100 million. And I'm going to go ahead and execute the trade that I think, because I've got the confidence in myself to take action. And those seem like the polar opposite of one another, but yet they both seem necessary. So how do you balance those two?
You know, well, let's go back to, this applies directly, in my opinion, to your blackjack analogy.
Yeah.
Right. As a trader here, you know, maybe it's difficult to draw the exact metaphor, but as a trader, you're really kind of, you know, when you're looking at the markets, you're sitting around waiting for an opportunity to, when you get to split tens, you know, and all of a sudden, you know, all of a sudden you see how, wait a minute, now the odds now changed for the price of this to go in this direction because something just happened. Yeah. Right. You know, and it's learning. It's learning that reaction mechanism and how to read a market's response to data, right? It's very much learning something like that. For example, when, you know, you get confidence to stay in a stock during a bull run when they're reporting mediocre earnings, but the stock is rallying. You notice that relationship. Earnings are coming out, they're kind of a mixed bag, et cetera, but the market likes the stock and the stock is going. And you'll notice the difference when all of a sudden it gets to a period that stock starts beating earnings and the market says, nah, that's not so great anymore, right? Like, you know, so you learn to say, okay, this is what's happening with this stock. This reaction to data is changing. So my odds that its behavior is going to change have just dramatically gone up, right? Now I'm splitting tens against the six. Yeah. You know, and so those are the opportunities that you want to get yourself into. And, you know, it's very difficult, but everything that I learned at J. Aaron from the guys that taught me was, you know, you get to put your chips on the table when the stars line up. Right. And when the stars line up and you'll see, okay, there's one more thing, you know, for example, I'm long commodities. I want to look for a chance to step on the gas. Right. Well, today the dollar is down. That's not going to hurt me. Right. That gives me confidence to step on the gas. Today, grains are rallying and metals are rallying. So that gives me a little confidence to step on the gas in other commodities because the asset class is working. Right. So you learn in the market, there are these different little nuances, and then you'll wake up other mornings and see something like the bond market going against you and say, oh, man, it's going to be a bad day for what I have on. Right. And then you're on to playing defense. But, you know, you get to switch from defense to offense when the market, sort of the market dealer, if I may, deals you those hands where it looks like the dealer is about to break and sometimes go on a string of breaking. And so that's really how I'm looking for that edge in the market where, you know, you get a couple of, we've been using the oil analogy, you know, the chances where the opportunities to step on the gas where you continue to get draws in the oil markets, you know, and you're long and you'll see the inventories dwindle down, you know, those are chances to sort of stack your bets up when you're in a trade and you want to add to it. So those are the sort of signals that you have to learn to read, and then also read, you know, conversely, when the dealer flips over, you know, a 10 and you're sitting there with your 2, right, you know, that's the time to shrink up the risk and say, you know, I really don't want to fight you today. Thank you very much.